Good afternoon, everybody. I welcome you to this EMEA webinar on digital financial inclusion, a pillar of resilience post-COVID-19. This webinar is organized under the umbrella of EMEA Regional Policy Research Initiative on COVID-19, which we launched on the 18th of March 2020. The main objective of this initiative is to facilitate shaping future policy responses and actions toward enhancing our socioeconomic resilience in Europe, in the Mediterranean and Africa, post-COVID-19 crisis. In April, we published a study that proposed a policy assessment framework for EMEA Monitor, which in fact, it is tracking every week on the basis of the policy responses and the performance in the countries of the three regions, means Europe, Africa, and the Middle East. The monitoring covers policy measures which are including the health system preparedness, containment, decontainment, economic preparedness and recovery, and overall effectiveness to respond to the pandemic and also to identify and mitigate the socio-economic consequences. This week, I just wanted to inform you that we publish an additional section on the monitor of the decontainment policies and measures. So please, all this information, it's on the website. We also published a number of policy papers on key elements, like, for example, the case today on digital financial inclusion, but also on the resilience of the banking sector, and also trying to really think about models of resilience post-COVID-19, which one of them was a paper on Lebanon and how to implement a model for resilience for this country. So also these studies are published on our website. Today, I'm very honored to welcome this lineup of distinguished speakers and discussant from international organizations and academic sector and think tanks. Let me start to welcome my colleague, Mais Shaban, who is a research fellow at EMEA and also an EMNES fellow. EMNES is the Euro-Mediterranean Network for Economic Studies, a network of EMEA. Purva Khera, who is an economist from the IMF, International Monetary Fund. Sumiko Ogawa, who is a senior economist in the IMF as well. Ghiyazuddin Ali Mohammad, who is a senior policy manager on digital financial services of the Alliance of Financial Inclusion. And a discussant, Isabella, who is a research fellow, Center for Financial Crime and Security Studies, Royal United Services Institute for Defense and Security Studies, RUSI, in the UK. So I would also like to welcome all the participants today who registered in the webinar. So let me, before we start, mention that this webinar contents and discussions are public and are live broadcasted on Facebook. Later on, a EMEA team will publish the recording of this webinar, and a report will summarize the main points of the discussions. So let us start. The objective of this webinar is to discuss the role of digital financial inclusion as a pillar of resilience during this crisis of COVID-19 and also post-crisis COVID-19 crisis. And then we are also trying to discuss today the challenges and opportunities. So I would like to start with my colleague Mais, with whom we co-authored a very recent paper on specifically on this topic. Mais, the floor is yours.
Let me just share my screen. So first of all, thank you for giving me the opportunity to present our recent work and policy paper on digital financial inclusion as a pillar of resilience amidst COVID-19 in the Mediterranean and Africa, co-authored with Ayadi. So I will start with the challenges imposed by COVID-19, government responses, and the link to financial inclusion. So containment measures taken by countries are essential to achieving a reduction in the transmission of the COVID-19. However, these containment measures imposed a heavy burden, particularly on households and MSMEs, in terms of business closures that negatively impacted their income and employment. So to respond to these challenges, governments implemented a number of policies, including social measures, such as the disbursement of cash assistance to the most vulnerable, monetary measures such as lowering reserve requirements, interest rate cuts, funding facilities and credit guarantees to finance MSMEs' operational costs, and so on. However, the reach and effectiveness of such policies are conditional on the ability of these groups to access financial services, thus making financial inclusion as the main pillar of resilience to absorb the shock. And this particularly raises the importance of digital financial services in such times where human interaction, mobility, and business operations are limited. So looking at the level of financial inclusion in the Mediterranean and Africa, in the Southeast Mediterranean, less than 50% of adults report having any type of account. There is limited usage of mobile money, and cash use is very high. For Sub-Saharan Africa, it ranks the lowest amongst all regions in terms of access to formal financial services, meaning provided by banks. However, mobile money accounts enabled broad success in reaching out to the unbanked. For example, in Kenya, where M-Pesa was launched in 2007, 73% of adults report using mobile money. Both regions are characterized by low levels of financial literacy, and the majority of small businesses do not have access to loans, and they identify access to finance as a major constraint. So all these factors represent a major challenge for governments in terms of reaching out to MSMEs, households in the informal sector who are severely hit by the pandemic. So our main proposal in this policy paper is digital financial inclusion, as it facilitates access to government support and the transmission of policies mentioned before. It eases the impact of movement restrictions and bank branches closures. It facilitates access to formal loan accounts via electronic records and reduces reliance on cash. So our main policy recommendations are as follows. First, promote greater use of mobile digital wallets. And most importantly, governments to work towards digitizing social payments, as this would enhance the trust in such payment services. We also recommend facilitating individual and MSME access to financial services, enabling them, for example, to open a new bank account online with key information requirements, which could be authenticated, signed online, and without the need to visit a bank branch. We also recommend reaching out to MSMEs that lack access to finance through innovative low-cost mechanisms. This could be done by enabling them to apply for credit guarantees online. Also increase digital awareness and enhance financial literacy, what is called digital financial literacy. And this can be done through utilizing different media platforms in order to provide financial education or digital financial education, targeting vulnerable groups such as the less educated, elderly, MSME owners, and women. We also recommend the inclusion of the gender perspective in designing the financial support policies, as social norms and culture may disproportionately impact the employment and income of women during the crisis. And this can be done through targeted lending mechanisms that facilitate access to credit with preferential terms for women-owned businesses. We also recommend more focus on financial inclusion channels in rural and marginalized urban areas through targeted enhancements for digital and internet connectivity. So governments to invest in digital infrastructure and make it affordable. Also targeted enhancements to financial literacy in these areas. Finally, ensure that compliance with international regulatory requirements does not have undue consequences in relation to financial inclusion. And here, digital identity has the potential to remove some of these major barriers. Beyond these actions, global and regional initiatives must continue to design tools and policies, strategies that will promote digital financial inclusion. We also recommend adopting a multidimensional definition of financial inclusion, integrating the digital dimension. So we define financial inclusion as making formal financial services accessible and affordable to all segments of the economy through utilizing both digital and traditional means. And the main idea here is that we construct a composite financial inclusion index, and we do this using the geometric mean method. So in fact, we construct 3 indices. First, we build on our previous work on constructing the traditional financial inclusion index, which mainly includes 3 dimensions: accessibility, availability, and usage. And for each dimension, we have 2 indicators related to formal financial services provided by banks. So branches and ATMs for accessibility, deposit and loan accounts for availability, deposits to GDP and loans to GDP for the usage dimension. And then we construct the digital financial inclusion index that includes the same dimensions, but with indicators related to mobile money. So for accessibility, we include mobile money agents, for availability, mobile money accounts, and for usage, value of mobile money transactions to GDP. And then finally, we construct the composite financial inclusion index that includes the indicators from both indices. So for accessibility, we have branches, ATMs, and mobile money agents. For availability, deposit accounts, loan accounts, and mobile money accounts. And for the usage part, we have deposits to GDP, loans to GDP, and value of mobile money transactions to GDP. So we construct these 3 indices for a global sample of countries. Here we have 4 countries in our sample: Bangladesh, Kenya, Pakistan, and Zimbabwe, that were able to advance financial inclusion significantly throughout the sample period using digital means. So if we look at the red line, the increase in this red line, this shows their improvement using these tools and indicators. So this highlights the importance of the inclusion of these indicators in the composite index. So the constructed indices of financial inclusion we show by region and income group. So the graphs show that the inclusion of digital indicators is particularly important for Sub-Saharan Africa and South Asia, and by income group in low income and lower middle income countries, to get a more precise picture of the state of financial inclusion. So that's all for me. Thank you for your attention, and back to you, Reem.
Thank you very much, Mais, for this presentation. I have one question. If you go back to the slides, the last slide.
Oh, sorry. Yes.
The last one, number 10. Yes, that's it. So you can see clearly that in MENA countries, the level of digital financial inclusion is pretty absent.
True. Yeah.
Although if you look at of course, the traditional, which we call it the traditional, it's pretty, I mean, it's a bit high. And then the composite is slightly lower. How would you explain this trend?
Yeah.
But there is also another point which I wanted to ask you. What is the impact of all of this? Is it the digital infrastructure that would have an implication to, for example, to the fact that in MENA, the digital financial inclusion is pretty much absent?
Yeah, so for just to clarify, Reem, these are means of the indices. So you can see that if the digital financial inclusion index is low, it will take the mean of the composite to become lower than the traditional one. So for MENA region, yes, it's the usage of mobile money is very new now. I think by the last 3-4 years, this trend of mobile money became more popular, especially in Jordan, Tunisia, and so on. So I think by time this would become better, I think the governments are promoting the use of such mobile money accounts. And I think the main reason is that in sub-Saharan Africa, they have really high cost of formal financial services provided by banks. However, in the MENA, it's a bit lower and more accessible. So this is why the sub-Saharan Africa region depend more on these services.
Okay, thank you very much. I think this is, we will continue this discussion with Purva and Sumiko. So now, Purva, the floor is yours.
Thank you, Rim, for giving us this opportunity to participate in this seminar. So today, me and my colleague Sumiko, we will be presenting the analysis and findings of our recently published departmental paper, which is titled The Promise of FinTech Financial Inclusion in the Post-COVID-19 Era. So in this paper, essentially, we explore the determinants, the role, and the economic importance of fintech-driven financial inclusion, which is what we also call, like Mais, digital financial inclusion, both before, during, and after the COVID-19 crisis. Now, there are two novel things about our paper. One, that our analysis and findings is not only based on data and doing empirical analysis, but we actually also conducted interviews with various stakeholders across the globe, and that includes fintech companies, banks, regulatory bodies, central banks, to capture what is actually happening at the ground level. And second, that to our knowledge, our study is so far the first comprehensive global study on fintech and financial inclusion in the literature. And of course, now we know that Mais and you are also working on something very similar. Today, we will be sharing with you a few glimpses of our key findings, but I will highly recommend you to read our paper, where you will find a detailed discussion of all the findings that we will touch upon today. Next slide, please. So we will first start by taking a step back and just take stock of what was going on before the COVID hit, because this helps us really to understand the likely role of fintech in financial inclusion, both during and post the COVID pandemic, which my colleague will talk about later in the presentation. So moving on to the next slide. So here we show the developments in financial inclusion related to digital payment services, and this is across 52 developing and emerging economies. So the left-hand side chart shows a snapshot of the extent of traditional financial inclusion, that is financial inclusion coming from banks, which is the yellow bar, and digital financial inclusion, which is essentially the financial inclusion being driven by fintech, which is the blue bar. And this is across different regions in 2017. We combine various indicators and data sources to compile these single measures of traditional and digital financial inclusion. And a higher number here indicates higher financial inclusion. And as you can see from the blue bar in the chart, the key takeaway from here is that fintech is undeniably leading to an increase in financial inclusion. And if you see, Asia and Africa maintain an overall lead in digital financial inclusion. And this is consistent with what Mais also discussed, whereas there is significant room for further gains in other regions, particularly the MENA and the CCA regions, both of which feature large unbanked populations. The right-hand side chart looks at how the traditional and digital financial inclusion are growing over time. And that's between 2014 to 17 across different countries. So a positive number in this chart here implies that it's increasing. A negative number implies that there's a decline in inclusion. And so there are two key takeaways from this chart. One, that in all countries, digital financial inclusion is increasing. So this is definitely good news. And two, that in fact, improvements in financial inclusion in recent years is entirely driven by fintech in some countries, and such as in South Africa, Zimbabwe, Nigeria, among some others. So what explains this rising adoption of fintech payment services? And this is where our interviews confirmed that this is because in comparison to traditional financial services, fintech services are more accessible. You can easily access them through mobile phones. They are low cost. They provide flexibility. You can use them at any time. They're user-friendly. They're more efficient, and they also allow for customization. So moving on to the next slide. In this slide, we show the developments in fintech credit. So the data in these charts are basically the loans from P2P lending platforms, which essentially directly connect borrowers to lenders. And the figures show the total amount of new P2P loan originations in a year for 105 countries. As you can see from the left-hand side chart, China clearly dominates the P2P lending space. Advanced economies come next, with US and UK leading others. In fact, China, US and UK together make up 98% of the P2P lending market in 2017. This market is also growing rapidly, as you can see in the right-hand side chart, and we actually see that happening even in some developing countries like Kenya and India. And fintech credit, as you can see, has gone up more than 3 times from 2015 to 2017. So what explains this rapid growth in uptake of fintech credit? And this is where our interviews confirmed that it is because in comparison to taking loans from banks, which is traditional credit, the loan application is much easier and super quick to fill out. Loan approval is instant. There is no collateral requirement. And it also provides a lot of flexibility and convenience. So to give you a fun fact, a lot of the fintech companies that we spoke to mentioned that they receive majority of their loan applications past midnight. Now, one could not do that through a bank. Plus, these firms are using big data analytics like machine learning and artificial intelligence, as well as alternative sources of data for assessing creditworthiness. Having said that, fintech credit is still small in comparison to bank credit, and yet not large enough to pose any systemic risk to any economy. So by saying that, I will now pass it on to Sumiko, who will talk about the role of digital financial inclusion both during and post the COVID crisis.
So let us now turn to what current COVID-19 pandemic and the crisis means to financial inclusion, and what role digital financial services could play in post-COVID. As also Mais indicated, the pandemic poses opportunities, but also the risks or challenges to digital financial inclusion. And it could also change the landscape for fintech industry. digital financial services have the potential to help cope with the economic fallout of the pandemic and in the recovery as well. But to reap the benefit, we need to strike a careful balance between enabling the innovation, but also addressing risks. So let me now turn to opportunities first. Looking at the history for similar episodes, for example, the 2003 SARS epidemic, it helped accelerate China's launching of digital platforms and e-commerce. The consumers' preference changed towards online transactions and purchases rather than in person. And this shift in preference helped them overcome the mistrust they had previously. And the companies responded by adopting e-commerce and online payment services. And a similar thing could happen in the current juncture. As Purva discussed, even before the COVID crisis, the shift towards digital financial services was already happening. And there has been a rapid growth in the take-up of mobile money, for example, also the fintech credit. And these led to a greater digital financial inclusion. And this trend will likely to accelerate, and governments in some countries are also supporting this shift with policy measures such as lowering fees and increasing limits to digital transactions. The greater and more rapid adoption of digital financial services could have positive impact in several ways. First, as Mais discussed in her presentation, they help ensure smooth and continued access to financial services. And they often cater to clients that are not serviced by banks, for example, lower income household and SMEs. So, and these are the ones that are being hit very hard by the current pandemic. So the digital financial services can help governments reach to these population with policy support securely and efficiently. And we also find that the greater financial inclusion goes hand in hand with positive macroeconomic outcomes. There are many existing researches that discuss the financial inclusion and its association with higher growth, for example, and also lower inequality. And in our study, we also find that the digital financial inclusion is positively associated with higher GDP growth. And this could reflect the fact that the financial services, access to financial services could help smooth consumption against shocks, or the innovation and the developments in digital economy also improve productivity. And these findings have implication on the role of the digital financial services post-COVID in the recovery phase. But these potential shouldn't be taken for granted, as acceleration in the adoption of digital financial services could also enhance pre-existing risks and bring about new sources of risks as well. So let me elaborate, discuss a few risks. Prior to the COVID-19 crisis, with the acceleration of the adoption of the digital financial services, there are risks to, for example, financial inclusion itself, to the financial stability, and related to the technology itself. First, on the risks to financial inclusion, if someone doesn't have physical access to technology and infrastructure, for example, mobile phone, internet, and even electricity, those people cannot be included digitally. And if there's as Purva discussed earlier, for example, the fintech credit lenders are adopting new technology and alternative data sources to assess the riskiness of the borrowers. So if there's a bias in how these data is used, some people could be excluded. And also existing financial institutions, such as the microcredit institutions, only have limited capacity to adopt digital technology, and as a result, they may be unable to compete with fintech companies and may be forced to retrench their services. And related to the risks to financial inclusion, there's a risk of excessive financial inclusion as well. As Purva mentioned, the digital financial services are very convenient and fast, but this means that it could lead to overborrowing or lending to less creditworthy customers in some cases. There are some anecdotal evidences of this. For example, in Kenya, there are high default rate among the mobile loan borrowers. And these people may get blacklisted and will be banned from the possibility to access credit in the future. Let me discuss a little bit about the risks to financial stability itself. If there is an arbitrage between the regulated and less regulated entities, it could lead to risks migrating from, for example, banks to newer disruptors, fintech lenders, for example. And this is not limited to credit. It also relates to the financial integrity issues as well. And there are risks related to technology itself. Obviously, the cybersecurity risks, which could undermine the trust in the system itself. And the lack of interoperability between systems could also limit the adoption of digital financial services as well, and its use. So these risks could lead to involuntary financial exclusion and loss of trust in the services or in the system as a whole, and could set back financial inclusion. So to avoid this outcome, it's important to invest in closing the digital inclusion gap. And also, as Mais was discussing, enhanced financial and digital literacy is very important. And it is also important to ensure that the regulation and supervision is up to date and keeping up with the development, including on data protection, financial integrity, cybersecurity, and interoperability. And investing in human capital is critical in keeping the innovation going. So further to these pre-existing risks, this crisis is the first test to the resilience of many fintech companies. And some, especially the small ones and those with thinner buffers, are being hit by the tightening of funding conditions, rise in non-performing loans, and also the drop in transaction and credit demands. And if these companies retrench their services, this would affect their clients, and they could lose access to financing or financial services. But also that if these smaller companies exit the market, the landscape could become even more concentrated among big companies. So it is important to maintain the competitive environment in the industry, and to support this, it would be helpful to accelerate the creation of governance framework for larger fintech companies. Thank you. Let me stop here.
Thank you both, Purva and Sumiko. I have a couple of questions. Excellent presentations, I must say, and it really gives a very good, I would say, introduction on the trade-offs between, as you mentioned yourself, competition versus stability. And I believe that, of course, the role of digital financial inclusion is important, especially as you mentioned in a recovery phase not only post-COVID, but also during COVID, because with the social distancing and restriction of movement and mobility, you need to access finance via digital infrastructure. Now, Now, your study is based on the role of fintech to enhance or to increase financial inclusion. So, of course, fintech has been a development over the last few years, and I was very interested to see that is led by China on the peer-to-peer lending. So so one first question to you, are those peer-to-peer lending platforms in China, number one, are they regulated and by who? And number two, are they accessible globally? Means that, you know, any country or any person who wants to get a credit, they can access them. So that's my second question. And also, you mentioned that there has been this is what you said, is that the fintech credit is not large enough to pose a systemic risk. That's what you said. But then don't you think that the growth is so rapid that whenever there is an accumulation of risk, then it would be rather, I would say, like always, it's too late to regulate. So if you don't regulate it as much as possible today or yesterday, then probably the growth will overcome, in fact, any possibility to regulate. My next question is on the cryptocurrencies, especially on the payment sides. Have you studied this within your research? Yeah, please, you can answer now. Yeah, if you can answer now.
Purva, I think you're muted.
Okay.
Sumiko, sorry. Thank you, Rim, for those questions. And Sumiko, do you mind if I go first and then you can just add to what? So on the third, let me start by saying that on the cryptocurrencies, so our paper, the departmental paper that was recently published, only looks at payments and credit mainly. So we don't touch upon cryptocurrencies or insurance side or saving side for now. But there is a lot of work by the IMF on even on cryptocurrencies as well as on central bank digital currencies, which a lot of papers that have also been written by our director of the Monetary and Capital Markets Department. So for those topics, I would highly recommend you to read those papers, which are all available online and they're published. On your second point about the, that the fintech credit is growing very fast, and I had mentioned that it doesn't right now impose any systemic risk, and that is only because if you look at the fintech credit numbers currently, and if you look at it in percentage of GDP, they are less than 1% in majority of the countries, and only in China, it's maybe close to 1 or 2%, but in others it's in 0.00 decimal points. So in that sense, it is growing rapidly. I completely agree with you, but currently, in the sense of if looking at just right now at the numbers, there is no systemic risk. But Rim, I completely agree with you that if it keeps growing at this pace, then there is, and which it will even more so because of the COVID-19 pandemic effect, that there is a need for regulations to strengthen and make sure that that we don't reach a point where it's that big and that countries are in trouble. On your first point about, sorry, what was your first point? Yeah, on credit, right? On P2P platforms. So if you look at China, what we observed, which is very interesting, is we looked at the number of P2P lending platforms in China over time. And it was very interesting to see, as far as I can recall, and I don't think we included that in our paper, that there was a surge in these P2P lending platforms before, I think, 2015 and 16. When there was this huge stock market crash in China that happened, and I remember during that time there was some regulations that were imposed which made it because earlier these P2P lending platforms were not regulated properly, and then there were some strict regulations, and I'm not exactly well versed with exactly what they were, but just making sure that these P2P lending platforms are registered and have appropriate licenses. And after that regulation, you see actually that these P2P lending platforms in China, they decline massively. So what you see eventually happening is that only the feasible and the viable P2P lending platforms end up remaining. On your question about whether these P2P loans are accessible from anywhere, so a lot of the fintech companies that we spoke to in China are expanding in other Southeast Asian countries as well. For example, in Indonesia, there are a lot of these P2P lending platforms that are actually functioning, which are originating from China, or it's Chinese investment in Indonesia. So they are expanding in other countries as well. So I think I would stop there. Sumiko, please go ahead and add if I've missed anything.
No, I think that was very comprehensive. Just to add on some minor point in the second question. I also agree with Rim on the risk of fast growth in the fintech credit and the regulation possibly being too late, too little. And that's why we also highlighted the possibility of risks migrating from the banking sector to sort of less regulated sectors. So, that's why we also highlight that the regulation and supervision should be kept up to date. And in fact, in some countries, there are efforts to strengthening the sort of oversight of, for example, digital lending platform, because in the current crisis, there are many digital sort of loan application platform that's being popping up, and there's some question in some cases about the transparency and the sort of conduct or the loan sort of terms disclosure. So I think, for example, in India, they sort of strengthen some of the requirements or disclosure requirements related to that.
Thank you, Sumiko. You mentioned the migration of risk from the traditional sector to the fintech sector. So through which channels?
So this is not only related to fintech sector, but typically we see bank lending versus non-bank financial institution lending. So this is more universal to tightly regulated sector to less regulated sector, and typically in the credit sphere.
Thank you very much. There was very interesting presentation. I would like to move now to Ghiyazuddin from the Alliance, Financial Inclusion Alliance. Please, Ghiyazuddin, the floor is yours.
Thank you so much, Rim. Thank you for inviting me. Thank you for inviting Alliance for Financial Inclusion to participate in this webinar. It is indeed an honor to be the only male member of the panel. Thank you so much for inviting again. We've talked a lot about the demand side analysis, about the risks and challenges related to digital financial services, specifically in the context of COVID-19. In my presentation, I will focus specifically on policy and regulatory related regulations to leverage digital financial services to respond to global emergencies. And I will specifically talk about the context of COVID-19. Briefly about myself, I'm Ghiaz. I lead the digital financial services work at AFI. We are a network of regulators and financial sector policymakers, largely working in the area of financial inclusion policymaking. We have regulators from more than 89 countries who are part of AFI, and we are a member-led, member-governed and member-sustained organization. Members pay us annual membership fees for the various services that we provide. So this policy framework that we've developed, it's available on the AFI website, and I've provided links to the website also. This was developed by the Digital Financial Services Working Group of AFI. We have around 62 countries who are part of the Digital Financial Services Working Group. So we formed a subgroup specifically to work on this policy framework, and this subgroup was led by Central Bank of Egypt and Central Bank of Liberia, and there were 12 more central banks who were part of this initiative actually. So this policy framework provides a broad guidance to the regulators within the AFI network on and beyond to come up with relevant policy and regulatory interventions to kind of leverage digital financial services in responding to the crisis and effectively recovering beyond the crisis actually. So it has 7 key contours. I'll go through each of the contours in my presentation, but briefly, they range from promoting and incentivizing digital payments, secure and resilient digital payments and technology infrastructure, enabling regulations, agent and merchant operations, facilitation of additional use cases beyond the conventional cash in, cash outs, and the need for coordination among stakeholders and broader cross-cutting issues. So these are the broad contours of the policy framework, and I'll discuss each of them in a bit. I think both the previous speakers talked about the role of digital payments, especially within the context of COVID-19, the global pandemic. Briefly, digital payments facilitate remote transactions and help in adhering to social distancing norms, and this is the reason many of the central banks and financial service regulators are promoting digital payments. So what are the key initiatives that are being taken? Waiver of fees and transaction charges is the most common that we have seen among the AFI network. Central Bank of Kenya was one of the first central banks to introduce waiver of fees, and from this region, Central Bank of Malaysia came up with waiver of fees and transaction charges. Excuse me. Beyond the waiver of fees and transaction charges, we've also seen awareness and sensitization initiatives across the value chain. Again, we've seen new cases emerging, new use cases through digital financial services emerging. We've seen new target segments emerging given the global pandemic within the digital financial services space. So there's a need to create awareness and sensitization across the value chain, not only the end users, but also financial service providers, but also the regulators actually. Finally, we've seen remittances, global inward international remittances coming down due to the downfall in the economic activity globally. So countries such as Philippines, Bangladesh, which are largely inward international remittance dependent economies, they have seen a reduction in inflows to the extent of 15 to 20% actually. So the least that policymakers and financial service regulators could do is make it relatively easier for the senders to send money back home. And an easy way to do is linking the recipient's e-money and branches banking accounts to facilitate inward international remittances actually. So in all my interventions, I'll frame the narrative in terms of the rationale for this policy framework. What are the key initiatives that are taken, and what are the things to note or keep in mind as we as regulators kind of try to implement this specific framework actually. In this instance, the thing to note is the interventions need to be time bound. This is because when you provide discounts and waivers on transaction fees and charges, it has implications on business sustainability actually. So many of the digital financial services providers are concerned that if this extends, to a longish period of time, it may affect their viability. That's why the policy framework clearly suggests that the waiver should be linked to the lockdown period, or the guidance should clearly mention that the so-called waiver could be for a specific period, like 30 days, 90 days, or 120 days, so on and so forth. Also, it is very important to engage with industry while coming with such decisions to provide reassurance. Of course, these decisions have to be taken on the basis of solid, grounded data available of the transactions that are ensuing. Otherwise, it may affect uptake and usage of digital financial services amidst the pandemic. The second point is on secure and resilient digital payments and the overall technology infrastructure. We have seen the increase in digital payments across all the segments thanks to the pandemic. It's funnily enough, COVID-19 is said to be the biggest reason for digital transformation. Keeping this in mind, many of the regulators have provided guidance on business continuity plans. This is both for themselves as regulators and financial service providers, actually. Countries within the network such as Nigeria, Pakistan have done this. Beyond the network, US, the New York Department for Financial Services has issued specific guidance on the need to have business continuity plans. Resilience of digital payments infrastructure, right from the endpoint security of consumers' devices, as well as security of software, digital devices, and infrastructure of the digital financial service providers is of particular relevance amidst the crisis. Actually, we've already seen increase in the number of phishing sites over the last 3-4 months. Google has come up with Google tracks the number of phishing sites through its Chrome browser. So it has witnessed a jump of 136%, if I'm not mistaken, in the number of phishing sites within the first 3 months of the pandemic. And governments have also started taking measures. UK's FCA, they have come up with a site specifically on awareness around cybersecurity for the end users and also for digital financial service providers. They witnessed within a month or two of the crisis, they witnessed 2,000 scams, online scams in the garb of saying, selling online or delivering things online, so on fictitious websites, so on and so forth, actually. The final point is to focus on emergency crisis and communication. So this crisis has spared none. So it's very important to set up a crisis communication mechanism wherein if critical teams get affected, what are the alternate plans, how this needs to be communicated to the external stakeholders, and all is something that this guidance provides. I'll go to the third point on enabling regulations. Again, this crisis calls for a nimble, flexible approach, and this crisis may also entail some regulatory concessions given the realities of the pandemic. Some of the key things that I would like to highlight here are apply simplified KYC and eKYC solutions where in a proportionate manner and in a manner which adheres to the standards set by FATF. We have seen within the network, most of the countries within the network have provided for simplified customer due diligence requirements, and they have also come up with guidance on eKYC. The Central Bank of Philippines is one good example. From the MENA region, Central Bank of Egypt has also issued guidance on eKYC. The key takeaway here is moving beyond digital identity. Many countries do not have a digital identity or have not mapped a digital identity to the financial sector related transactions actually. So in that context, looking at alternate forms of identity, alternate forms of onboarding customers is something that regulators need to look at. Consumer protection and data privacy has also become extremely important. Colleagues before me also pointed out about the risk of exclusion. In this crisis, in this setting, most of the poor and underserved segments remain vulnerable to digitization, and also remain vulnerable to exploitative practices of some of the nefarious digital financial services providers. So monitoring for abuse from a perspective of consumer protection market conduct is something that regulators should definitely look at doing. The final point here is on leveraging subtech and regtech in order to facilitate compliance, and also in order for better reach out with the customers and stakeholders. Like many of the central banks have set up crisis call centers. National Bank of Cambodia is one good example here. They have set up a call center with 20 dedicated lines because Cambodia is a mature market for microfinance, and amidst the crisis, there are a lot of stressed customers. There's no situation of mass delinquencies yet, but customers are increasingly facing the pressure for repayments, so on and so forth. So National Bank of Cambodia has set up a call center for consumers to reach out to them if there are cases of exploitative practices, unfair treatment, so on and so forth actually. This is about enabling regulations. I'll move to the fourth pillar on agent and merchant operations. Agents are like the financial frontliners of this crisis. I'm talking about the cash in, cash out agents, the broader digital financial services agents in this context. There's a need to identify and notify mobile money and agency banking as an essential service. Countries such as Ghana and Bangladesh have already done it, and there are many other countries also who have done it. But this is something that regulators need to work with the central governments to ensure that they are classified as an essential service in order for these services to continue amidst the lockdown action. Liquidity management has also become a big issue, especially given the fact that many of the governments are routing their emergency cash transfer and social cash transfer funds through the agents. So it's largely cash outs happening. Agents are finding it difficult to manage their liquidity, honor the cash out transactions. So linking up with local liquidity support points, could be post offices, could be retail bank branches, petrol bunks, so on and so forth, is something that regulators should work with providers to ensure efficient liquidity management. And one final point on the need to provide dedicated services to vulnerable customers. This crisis, as we all agree, has affected all, but the level of impact has been quite disproportionate among various segments, and there are vulnerable segments such as disabled women and the elderly. So providing dedicated services to them, so maybe maybe initiatives such as exclusive services to the elderly, to the disabled, or even to the women, depending on the cultural context, in the morning or in the evening, could be something that the providers can consider and regulators can work towards. Beyond the financial services payments related guidance, there's a need to also kind of ensure awareness and training on hygiene and social distancing. Some of the countries like India and Kenya are already doing it, but there needs to be a broader, much deeper role that agents need to play in terms of educating the customers on hygiene and social distancing. The next framework is on facilitation of additional use cases. This crisis is a very good opportunity for moving beyond cash in, cash outs, moving beyond payments to additional value added products. Digitization of G2P payments is imminent. It's already happening, but beyond G2P payments, products such as insurance, remittance, SME lending through digital rails is something that providers need to work towards, and regulators need to also proactively collaborate with the digital financial services providers to create a cash-light economy in the medium to long term, actually. Coordination among stakeholders, this is as important as it can get, actually, because many of the members in our network have indicated to us that there is a need for their voice to be heard at a national level as well as at regional levels, actually. So what we are suggesting here is to have a national, if there are many countries already have a national task force. So if there is such a national task force already present, central banks should have a seat on the table to provide their perspective and to represent the vulnerable customer segments while coming up with policy related interventions. So there's a need to be part of discussions at the national levels through a task force. There's a need to be need to set up an internal task force within the central bank, interdepartmental task force to respond to that crisis, but also a task force or a working group which comprises of broader stakeholders to work on various issues related to responding and recovering from the crisis, actually. So that's about the coordination. The last point is around cross-cutting issues. Colleagues before me have already talked about the need to look at vulnerable segments, especially women, because women have been disproportionately affected from a financial services standpoint. So targeted support programs towards vulnerable segments is something that the guidance suggests. Finally, on the point of recovery, there is a need to infuse green element. So this crisis has provided a good opportunity to kind of break all the hegemonies that we had with respect to cultural, socio-economic barriers that disproportionately benefited certain segments and negatively impacted certain other segments, actually. So starting with a plain sheet of paper and kind of looking at coming up with policies which are equitable across various segments, and also from a sustainable and green finance perspective, infusing green elements into the policy making process is something that this guidance talks about. So it could be in terms of environmental impact assessments, providing digital rails to energy efficiency, green related business models, so on and so forth, is something that this guidance also, this specific guidance talks about. So these are the 7 major contours of the policy framework as part of the response for leveraging digital finance in responding to the COVID-19 crisis. Thank you so much.
Thank you very much, Ghiyazuddin. This is very comprehensive, and thank you for this very clear framework, which really brings a good I would say, framework for discussion for Isabella. But before that, I would like to make a couple of comments and questions to you. One thing we've seen during this pandemic is that the use of cash has not been in the forefront at all. So it means that this is in fact good news, because the use of cash, which generally is, I would say, not desirable if you want to tackle informality, has been, in fact, or should be reduced, because I haven't seen the data on that. But the question to you, have you seen a reduction in the trend of use of cash in the countries where the alliance is active? That's my first question. Second question, you mentioned remittances. Of course, we had a discussion a couple of weeks ago about remittances and how it has declined for more than 100 billions based on the data of March 2020. So obviously this had implications, and then whatever remittances that has remained, obviously what is important is to reduce the costs of sending and transferring money, and you mentioned it as well in your presentation. And I think this is also probably part of the maybe the role of financial or digital financial inclusion providers, which in fact would reduce as much as possible the cost of transfers of this very important and livelihood financial mean for the vulnerable populations worldwide. So I want to have your view about this. My third point is, again, also I made it previously, it's about the cryptocurrencies. How do you see the cryptocurrencies in this debate? Do you see it as a mean to increase financial inclusion, or what is your view about it? And then I have another point, which I was pleased to hear it, is remote supervision. So what do you mean by remote supervision? I want you to elaborate a little bit on that. Thank you. Please.
Thank you so much. On your first question related to the use of cash, has it reduced and all? So of course, there is no substantial data to kind of provide an answer to you on that. Although what we know was, as the lockdown started and as the incentives for digital payments increased, countries, especially with a fairly good digital finance ecosystem, witnessed a rise in digital payments. But that was again for a month or a month and a half, and then the transactions started tapering down, reflecting the fact that there are surely interlinkages between the broader economic activity happening and its manifestation towards digital financial services and digital payments in particular, actually. That's based on discussions with some of our members. Again, I do not have hard data to substantiate my assertion here, but this is based on discussions with some of our members within sub-Saharan Africa. That's on the first point. Second point, on the remittances. So you want me to elaborate on the potential of digital platforms or digital financial services in reducing the cost of remittances and creating efficiencies around it?
Correct.
Okay, yeah, of course. Notwithstanding the crisis, I think it's fairly well proven that remittances through innovative technology-enabled channels have been able to reduce the cost of cross-border remittances. I think, if I'm not mistaken, the average global cost of transaction for sending $200 into an emerging market economy is around 7.5%, while through a digital payment channel, it's less than 5%. I can give you the exact numbers, but obviously there are benefits in sending money through digital channels. On your third point related to cryptocurrencies, I mean, I'll provide my own view here, because as AFI, we have not looked at cryptocurrencies as such. We have not been able to draw clear linkages between cryptocurrencies and its linkages to financial inclusion yet. At a scalable, manner, in a manner kind of looking at the vulnerable segments, true advanced inclusion and all, we have not seen any like core linkages between cryptocurrencies and financial inclusion. Third, on remote supervision, of course, I will provide a digital financial services context here. So earlier, when it came to supervising or monitoring the cash in, cash out networks, regulators used to regulators visit the agents on a periodic basis or do mystery shopping initiatives, so on and so forth. Now that's happening remotely. So data is being taken from the DFS providers, and then data is being looked at, so on and so forth. So those are the key initiatives that are being taken. Again, a lot of compliance and reporting requirements were happening in a rather physical manner, wherein like files were submitted to the central bank, so on and so forth. Now, what is happening is that is happening in a digital manner actually. So these things are happening for good. Hopefully they'll continue beyond the crisis. Thank you.
Thank you very much. So I think we have enough food for thought for Isabella. So Isabella, you had very comprehensive presentations today. I think many issues have been raised, not only to have on the trends of digital financial inclusion, but also on the trade-off between competition stability, also the role of fintech in enhancing financial inclusion. And as we heard, all these pillars to develop a framework for financial inclusion that is accessible and that's serving all, while taking into account the obstacles and probably the challenges within this development. So the floor is yours, Isabella.
Thank you so much, Rem, and thank you for having me today. As you said, my colleagues on this panel have given so much food for thought, and I'm going to struggle to fit everything in. So I'll make reflections on each of the presentations, and I'll just conclude also by posing a couple of questions to do with some security concerns that haven't been mentioned yet, to do with considering digital financial inclusion as a pillar of resilience post-COVID, because of course we don't want that resilient pillar to be undermined by security concerns. Starting with Mais, in your paper, I think you make some great recommendations at the end of the paper and in the presentation of how we can really work through this problem in a really sort of thought out way. I thought your idea about including digital within the definition of financial inclusion is really important, something that we found in our research is you see an issue to do with how you measure financial inclusion because of inconsistencies in definitions. I think including digital from the outset, which is really just the nature of financial inclusion nowadays, really important and will help with some of those inconsistencies in measurements. So that was brilliant. A theme that has come out of all of the presentations, but you guys mentioned it first, was this issue of financial digital literacy. From our perspective, one of the biggest challenges and threats posed by the COVID crisis is fraud threats. And when you have digital illiteracy, you see an increase in fraud as well. So putting a lot of emphasis on increasing education and financial literacy, especially in things like mobile money, I thought was a really important point. And it also speaks to that idea of trust that came through in the IMF's presentation. You know, if you want to use digital means to digitize government payments, it's going to be integral that that's based on trust in those services to facilitate adoption. And for me, that goes hand in hand with education and awareness. You have to know about the thing before you can trust it and make sure that you're not exploited by any weaknesses in your knowledge. Those were some key takeaways for me from the first presentation. From the second, I thought the conversation about the trade-off in risk between traditional banks and fintechs was a really important one. From the area of expertise that I come from, which is financial crime, this is something we see really often. You see financial crime risk moving from traditional banks to fintechs who may not, despite their best efforts, I would say, they might not be fully equipped for the financial crime that they experience. And it can be quite a common thing that you see people bring new products online, they get targeted a lot by criminals, and they either have to sort of pause that service for a while and change their offering to make it more robust. So 100% that's something that we see. But we also see, to your point around one of the issues in building resilient digital financial inclusion is about regulatory speed and making sure that regulations can catch up with innovation. Again, in the financial crime arena, we see in emerging markets that often new digital financial services don't fit within traditional financial crime legislation, which is designed for banks. And often you have maybe special sort of more niche payment service providers not really fitting in the definitions within legislation, and so they're not really regulated for financial crime. They might be in active conversations with their central bank, and in that way they're sort of protected, but you can see a vulnerability created there. So again, I think I would completely agree with the point made by Purva and Sumiko that you have to really make sure that regulatory frameworks keep pace with innovation. And you know, that's difficult during a crisis, absolutely, because everything is moving so quickly. But if you want to build long-term solutions, I think after this period of potential experimentation with these products, it's essential that we, you know, bank regulators come together, think through what worked, and build robust regulations around them. Moving on to that, you also briefly made a point about human infrastructure. Absolutely, if to support fintech in these markets, we're going to have to make sure that there are the people who can drive innovation. And I wonder if there's a potential opportunity around, you know, we're seeing large numbers of people becoming unemployed. How can we reskill economies and maybe some of those unemployed people to help fill some of that digital gap? So that going forward, again, you know, this is a really resilient pillar because we've got the human capital behind it that can support it. Of course, how you resource that reskilling can be quite difficult and also expensive, but definitely sort of something to think about. On the final presentation and sort of related to that, you mentioned that you have to ensure that digital technology, the infrastructure behind digital technology can grow. We also would argue that it's really important that financial crime controls scale at the same rate as fintech growth, which is actually a problem that we see in the UK quite often. You have fintechs that grow really, really quickly, but their compliance team across all of their regulations might not grow at the same pace. And it's really important that sort of when founders and operations teams are making increasing their workforce, that they make sure that they fulfill those compliance gaps. I must say I'm a huge fan of the AFI policy framework. I think it really considers all of the key points that will ensure for long-term really sustainable growth in this area. I think the issues around flexible KYC are there. I think it is possible that there might be unintentional risk entering the system because of flexible KYC models and simplified due diligence. I think they're really necessary for the moment, but I think it's important that we're wary that there is risk that accompanies those products. But as you mentioned, there are governments around the world who are doing great work in this space. The FATF has also released a really useful document that details countries who have implemented simplified measures that, they don't give them a tick, but we feel, because they're included in this document, that they're sort of to an extent endorsed by the organization. On that point, and just on the conversation that you just had on SupTech and RegTech, I think these are really important technologies to accelerate the adoption of new financial services. But again, they're very dependent on having infrastructures and technology already in place. Firstly, thinking about human capital, but also making sure you have the computer systems. So I don't think they're always a given, and I think there are quite a lot of physical barriers to their adoption. But I think one of the great things that happen when you can successfully adopt RegTech and SupTech is that you can make better use of the data produced by fintechs, which can be much richer and easier to use than traditional financial services, because it tends to be in a much more structured fashion, and so you can conduct much more effective supervision, whether that be on site or remote, which just in the long term will give you more robust financial services. Very lastly, on a point around coordination between stakeholders, I think absolutely that's so important. I think events like this are really useful for sharing insight, as are a lot of the AFI events that are happening at the moment. This is a problem that is affecting everyone, and so we might as well try and solve it together. And just borrowing off one of those learnings, creating phone lines to assist with rapid regulatory change is something that we've heard anecdotally has been really helpful in a number of markets, and you don't necessarily have to go for a really complex solution. Just setting up communication channels for regulated populations to talk to their supervisors, or supervisors to talk internationally with other supervisors, has been a really good way of sharing best practices. So those would be my initial reflections on the presentations. I think it's great to see that there's just so much work going on in this space at the moment, and I've barely scratched the surface on what you guys have said. So that just is such a testament to all of the great research in this space. Do I have time to very quickly touch on some financial crime concerns?
Yes, Isabella, you have.
Awesome, thank you. So something that we looked at RUSI, at the Centre for Financial Crime and Security Studies, is the financing of threats and also the use of financial intelligence to disrupt threats. And increasingly we look at unintended consequences of financial crime controls. And something that we think about a lot is, well, if you're going to have digital financial services as a real pillar for financial services in the future, regardless of crisis, you have to ensure that those aren't going to be undermined by financial crime. And it's interesting to see how this crisis has impacted financial crime and how that has moved more into the digital space. Where we've seen the biggest and probably the most substantial change is in the fraud space, as has already been mentioned. But we see a huge amount of changing fraud typologies, basically targeting where the money is at the moment, and the money is in COVID responses. So whether that be in PPE scams or linked to exploiting government disbursements, we're seeing a lot of criminal movement in that direction. I mean, a key example was when Washington State in America opened up a new unemployment benefit scheme, and it was targeted overnight, losing hundreds of millions of dollars that should have gone to the unemployed. And when you think about the fact that 1 in 6 people around the world, according to the World Bank, now have access to some sort of government disbursement linked to the COVID crisis, there's a huge pocket of money there that can be actively exploited by criminals. And we have to think about how can we protect those disbursement schemes against being lost to financial crime. It's not just fraud though, although that is probably where the largest quantity of harm is. We also see changing methodologies in money laundering. We've spoken a couple of times today about the reduction in the use of cash. Well, cash intensive businesses are a really common way for criminals to launder money, and all of a sudden they've lost that output. For example, we see dollars building up in North America and Mexican cartels struggling to bring them south of the border. We also see similar problems in Japan with the Yakuza, who are struggling to launder money through through cash-intensive businesses like bars and brothels. Where is that money going? We, at this moment, just don't really know, but it's important to understand that although it would be difficult to use some of the government disbursement models to launder money, it's not impossible. So you could imagine that if you had an offering of a basic bank account from a government, you could launder $1 million through $10,000, $100 transactions if that's where your threshold was capped on a basic bank account. It's labor intensive, but it's not impossible, especially if you're going to automate it. So again, we have another risk there that needs to be built into basic bank accounts and other types of digital financial service offerings to make sure that they're not exploited by criminals. And lastly, an area where we don't see much volume, but we see a huge amount of potential harm is in terrorist financing that requires very little money. And so is sort of ripe for the use of basic bank accounts. If you reduce identification requirements on an account, or you delay them, which is something that we see in certain parts of the world, to allow access to finance, you could also allow sort of terrorist financiers into the system. And if that product has a cross-border transaction functionality, it all of a sudden becomes incredibly useful for terrorist financing. So what I would say is that, digital financial services absolutely are crucial for financial inclusion. They will be a pillar of resilience post COVID-19, whenever that is. But it's really crucial that when we're thinking about them, we design financial crime controls in from the offset to ensure that they're not undermined in the long run by exploitation by criminals.
Thank you very much, Isabella. Before I go back to the speakers, I would like to ask you one question. You mentioned that the methods to launder money have changed, of course, because less use of cash and so on. Do you think the cryptocurrencies have been a vehicle for this new criminal activities?
I think that, cryptocurrencies are always to some extent used to launder some money. It's very little. Criminals face the same problem as normal consumers. There's a huge amount of volatility in that market. You're likely to lose some money. And of course, there's always a cost to money laundering, but you have to weigh the cost benefit analysis over it. Equally, we're getting very good at tracing the mainstream cryptocurrencies. So I wouldn't necessarily say that they're completely anonymous or risk-free from a criminal's perspective. There may be other more attractive ways of laundering your money. Where we see people taking that risk is more in the sanctions evasion space, and it's something you see a lot in the case of North Korea, them seeing deciding that the costs do outweigh the benefits when it comes to money laundering using cryptocurrency. But of course, that's a very extreme example, and your sort of more common transnational organized crime gangs probably would decide to rely on less volatile means of money laundering.
Thank you. Now I would like to turn back to the panelists. I will start with the reverse order. Ghiyazuddin, the floor is yours if you would like to react on Isabella and also on the dark side of financial inclusion, please.
I think the technology-related risks are going to surely increase. We are already seeing this both in developed and emerging market economies. The example that Isabella gave of many of the beneficiaries of these government support programs being scammed it extends beyond America in many of the emerging market economies also. Beyond AML and CFT, also there's a need to kind of build resilience. What AFI's position is in terms of technology infrastructure is to take a rather proportionate approach when it comes to building your digital financial services infrastructure. It may not be possible for a startup that has a wonderful product and a use case to come up with the best technology standards and the best technology infrastructure in the world. So the regulatory approach in this instance is for the first few hundred customers. It could be through a regulatory sandbox structure or through a test and learn kind of an approach. So as the number of transactions increase, the security requirements, the adherence and compliance to international standards need to increase accordingly. This approach is already being followed by many of the AFI member countries as well as developed countries. Singapore is a good example. They recently came up with a payment services regulation, which talks about this approach of taking which strikes a balance between providing space for innovation and at the same time ensuring resilience as the volume and the value of the transactions increase actually. So that's my take. Thank you.
Thank you. Sumiko?
Sure. Perhaps if I could react on Isabella's point about the human capital development. I really agree with you that when we did the interviews with the fintech company, many of them mentioned that the lack of skilled experts as one of the constraints to expanding their businesses. And as is the case with sort of education, human capital development in general, these are long-term issues and there's no sort of quick, easy fix to it. But I agree that it is important to invest in this area, along obviously for the education on the financial and digital literacy as well.
Purva?
Yes, thank you, Isabella. I think you summed it up in a very nice way, all the presentations. So I think just to add to your point that you highlighted again was the importance of the regulatory environment to keep pace with the developments in fintech. And this was one thing that came up across, I think, all countries, all the fintech companies that we interviewed across all countries, and they mentioned the regulatory uncertainty being a key constraint to their expansion. And they also mentioned that frequent changes in the regulatory environment was in some sense a constraint rather than a clear roadmap with, for example, tighter regulations. And this also ties into what you mentioned about financial crime, that that is a very important aspect that needs to be addressed. And on top of that, related to financial crime and even related to predatory lending practices that have been ongoing across many of these fintech companies, the fact that they are lending money to vulnerable sections of the population at exceedingly high interest rates, and when they are not able to pay the loan back, that they have the mechanisms through which they chase these people down and threaten them is actually quite worrying. So I think even in that respect, consumer protection, data privacy, etc., all these things need, in fact, an international cooperation related to all these topics on regulation. So I'll stop there.
Thank you. Mais?
Yes, thank you, Isabella, for your discussion. It's very interesting. I think the point raised on the link between fraud and financial literacy is very important, and maybe financial literacy programs should take this into consideration in designing the programs. And of course, there might be a trade-off between regulation and inclusion, but as mentioned before, maybe these tools such as digital identity and so on has the potential to remove the barriers and help in enhancing financial inclusion. Thank you.
Thank you very much to all the panelists and the discussant. It was a very informative and very interesting discussion today. One thing for sure, that digital financial inclusion is there to stay. Obviously, there is a lot of work to be done in terms of increasing the skills, literacy, effective regulation and supervision, which is currently lagging behind. Dealing with security issues linked to, for example, anti-money laundering, terrorist financing, and financial crime. I think this is important and has been very much highlighted by Isabella. But also beyond this, we also need to also think about consumer protection. And I think consumer protection is in the heart of these developments. So then, not to have, as Isabella said, the digital financial inclusion, which is an important development as a resilient pillar for to mitigate the consequences of the COVID-19 and also in the post-COVID-19 recovery, not to be undermined and then lead to security issues and other complicated issues to deal with. So I would like to thank you all. I would like to thank also the participants who have been patient to listen to this very interesting panel. And from the Euro-Mediterranean Economists Association point of view, and also its network, the Euro-Mediterranean Network for Economic Studies, we will continue doing research on financial inclusion, also linking it to digitalization and trying also to understand what are the prerequisites and the conditions for it to function in the Middle East and Africa. Of course, this is our target countries, but also looking at the European developments, which in fact nowadays there is quite of a progress in this respect. So thank you very much again for this great discussion. Now our webinars, this is our last webinar in fact for before summer holidays. We will reconvene again with the next webinar in September 3rd, and it will be dealing with the future of globalization. Thank you very much, and I hope to see you all. Perhaps we would like to have a picture with everybody. So Kinga, if you would like to allow everybody to switch on his camera so we can have a group picture, like always. If you can turn on your cameras, please, so then we can take this final picture. Okay, are we done? Okay, thank you very much, and I hope to see you in the next webinars. Bye-bye.
Thank you so much.
Bye.
Thank you again for inviting.
Bye.